Hi, I'm Chris and welcome to Tax Free Family. Today we're discussing the difference between whole life and IUL. Let's get into it. There are two basic types of life insurance, term and permanent. Term is short term and quite cheap, but once it expires, you and your family are no longer covered. Permanent insurance is a cash accumulation vehicle that lasts after you've completed paying premiums. It will continue to grow after you've paid. Under the umbrella of cash value or permanent insurance, it consists of two parts: a savings or investment portion that continues to grow, and an insurance portion for your beneficiaries that also continues to grow. Let's break it down further. The two main types of permanent cash value insurance are whole life and universal life. Under both, you commit to a monthly, quarterly, or annual premium or contribution. You can also contribute a lump sum up front, which is recommended to create more efficient cash growth to your policy, but also not necessary. Under both whole life and universal life, your cash value increases tax deferred with every premium payment, and the interest you earn grows tax deferred, which increases your cash value. Currently, there are four vehicles available to get tax-free income in retirement: a Roth IRA, Roth 401k, municipal bonds, and permanent life insurance. Because permanent life insurance takes advantage of IRS code 7702, which allows the income from your policy to be tax-free, your money grows tax-free, there are no taxes on cash distributions, and your beneficiary pays zero taxes when they claim the life insurance death benefit. I'll say that again. You and your beneficiaries pay zero taxes when these policies are paid out. Permanent life insurance gives you protection from stock market crashes or downturns. There are no contribution limits like with Roths or 401ks, no age restrictions like with Roths or 401ks. You have easy, penalty-free access to your money. Most life insurance policies include living benefits, where you have access to the death benefit tax-free while you're alive if you are diagnosed as chronically, critically, or terminally ill. It allows the death benefit to be distributed before death to pay for qualified medical expenses and long-term care. This can be crucial if you live alone. One of the most powerful concepts behind permanent life insurance is the ability to access your cash by taking loans for your cash value toward anything. You can finance a car, a vacation, or real estate. You have unlimited uses on your loans. Because you're actually borrowing from the insurance company, they're using your cash value as collateral. So even though you take out a loan, that collateral money is still in your account and it can keep earning interest above the cost of the loan, which is great for compounding your wealth. So now, here are the key differences between whole life and universal life. With whole life, you have a guaranteed level premium payments that will never change. Cash value accumulation is guaranteed at a fixed rate. Interest paid is typically adjusted annually, and you may also receive an annual dividend if your policy is with a mutual insurance company. The dividend is part of the insurance company's profits, and you can opt to receive it annually in cash, let it accumulate interest, use the dividend to reduce your policy's premiums, or buy additional coverage. The death benefit is fixed and it will never change. Now, to universal life products, where there's more flexibility. With fixed universal life, you have a fixed rate of return, just like with whole life. Cash value accumulation is guaranteed at a fixed rate. However, your premiums are flexible. So if you need to reduce premiums for a time due to unforeseen circumstances, universal life policies help to make sure the policy doesn't lapse. Also, interest paid is adjusted monthly, not annually, like it is with whole life. So if there's a period of rising interest rates, universal life policyholders will see their cash value grow at a higher rate than whole life owners. But there's no dividend, and the death benefit is flexible, not fixed. With indexed universal life, or IUL, premiums are flexible and cash value accumulation is based on the performance of a stock market index that you choose. So if the market is up 9% one year and 10% the next year, all of that growth is earned into your policy. Interest paid is adjusted monthly, there is no dividend, and the death benefit is flexible. All right, I used the word indexed. Let's talk about what that means. With traditional investments where your money is in the stock market, the stock's value will rise and fall with the value of the underlying company that sold the stock. It can be very shaky and change minute by minute, even crashing completely. But with indexing, a small percentage of your premium is used to purchase what are called stock options from the insurance company. Stock options allow the insurance company to purchase stock at a better price than they would pay otherwise. As the insurance company makes money from the resulting stock trades, you are credited with cash. How much cash you get back is based on the index that you chose in your policy. Your money is not invested in the stock market, but it is used to buy options, and you get a return based on the movement of the index. Typically, the money you are credited goes up until it hits a cap called a cap rate. Anything above that cap, the insurance company will keep. For example, we'll say a 10% cap rate. Now, if the market grows 20%, you are only credited up to the 10% cap. But the trade-off is complete downside protection from market losses, the floor, which is why I believe that a diversified portfolio should have these policies as a safety feature. Your cash value will not decrease if the market crashes. Let me repeat, you will not lose cash if the market crashes. But make sure that you're paying your policy premiums. The cost of insurance is another factor in the growth of your account. Whole life gives you fixed premiums, guaranteed returns, fixed death benefit, and a possible dividend, but it is the most expensive type of insurance. And IUL gives you flexible premiums, market-like returns, flexible death benefits, no dividend, and minimal fees if structured properly. Whole life insurance is the best choice for someone who wants guarantees. An index universal life policy is best suited for those who want flexibility and upside potential. If this video has been of value to you, please hit the like button, make sure to subscribe, and hit the bell to be notified every time I upload a new video. Also, comment below with any questions you feel the community can benefit from. I'll answer all that I can. Cheers, folks.